Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the world of business, finance, investing and politics to understand what's really going on in this pandemic and how we can position ourselves to survive and hopefully thrive as we come out the other side. My guest today had a successful career in investment banking, being at director level in companies like Schroders, Credit Suisse and Societe Generale, before deciding to set up his own boutique family office investment operation called Plain Money. As well as being a successful investor, he's also a writer on the topic, and he's written cover articles for magazines like Money Week, one of which was all about having 10 stocks that you could own for your entire life. His name is Stephen Connolly. Stephen, welcome to Money.
Hello. Hello, good afternoon, and thank you for having me. I'm very pleased to be here.
Pleasure. Well, one of the things I find fascinating is that really it's every business owner's dream to be doing something they enjoy, but also to be handpicking the clients that they do it with. I know you're quite selective about your clientele. What are the sorts of people and profiles that you enjoy working with the most?
Well, I think really, I mean, I am in a lucky position really, because as you said, I started this business about 4 years ago now, and it really was, it really was client-led, because I've had some people, I've had relationships over a number of years, wealthy families, wealthy individuals, all very entrepreneurial, and we found really that the restrictions within the private banking world and the wealth management world were, quite onerous, and we felt that in actual fact, if we set up independently, we could achieve more than working with one private bank. And so, in effect, I set up a family office with a small group of entrepreneurs, and I helped them manage their money and invest their money. And also, after a long career in investment banking, as well as a period in private banking and asset management, I feel that I represent someone who, if you like, is a poacher turned gamekeeper. And so I am able to set up multiple relationships now for these clients with many banks, but help them understand what bankers are saying to them, what is the truth of what they're saying to them in terms of fees, etc., and help them make correct decisions based on my experience. So that's largely how it came together. And so far, it's worked very well. And these clients have stayed with me, and we've grown the assets, and they've made more money and invested. And it really is, a business where we're not particularly seeking to grow. It's of the right size. It's private, and very, very bespoke and very, very personal. But when we have friends or people we know who also need the service, then we look to help them as well. But it really is a very personalized relationship in terms of investing, life advice, money advice, business advice, and really working very closely with them.
Yeah, it's interesting, isn't it? Because I often feel that people can be very successful in their core business, but they often wonder, who on earth can I turn to help me to take money out of the business and start investing it? And oftentimes their experience with the big wealth managers and private banks doesn't exactly leave them massively impressed. I mean, clearly you found a similar kind of experience with them.
I think so, because if you're, if you're happy to, how can I explain it? First of all, your original point is that, yes, you're absolutely right, that these people who we look after, these people, and people as well, they've started their own businesses or forged their own careers in one of their professions and made significant personal wealth, built significant personal wealth. No one can doubt their expertise in the areas in which they work, whether they're in the law. A number of my clients are in the movie business and series on Netflix and movies, all that sort of thing. So they're extremely talented, and they are generating at periods significant amounts of cash. But their blind spot, of course, is investing. And although they need to do something with the money, who do they go to? And even if they go to someone recommended, how do they know they're getting the right deal? Because they do not have the means to benchmark or compare these different managers because they don't understand the language or what's being offered to them. And it sounds patronizing. They are very bright people, but it's just not an area in which they've had any interest before. They're working on their main career. And, you know, there are many things that can be done for clients. And we found that over time, banking, under regulatory pressure, certainly private banking wealth management, has often increasingly taken a risk-averse approach to its business. Now, of course, a company should have a risk-averse approach to its business in a regulatory sense, but it does mean that many of the activities you might have associated once upon a time with a private client stockbroker or a fund manager in terms of advice very specific to the client has largely been, you know, often swept away in favor of discretionary model portfolios, etc., which are centrally controlled, and therefore the company perceives them as less risky because you're not giving advice to someone and therefore likely to be sued, etc. And it means also that I think the skill set of the relationship managers, as they're called, or the bankers, has gone down because, you know, I was someone that came from an investment banking background, an investing background, and could offer that to clients face to face. But many homegrown bankers these days are simply regurgitating marketing pitches for discretionary management. So they've never managed money, they've never given advice before. And so, you know, it looks nice and bespoke on the outside, these banks, and all very shiny. But inside, you're just getting a bog standard portfolio largely, unless you are very big. And we're talking £50 million plus. You know, you're not bespoke really at all. And just because someone's called a relationship manager doesn't necessarily mean they are really able to manage a relationship. I mean, we're talking about people that want to borrow, invest, do private equity, buy derivatives, trade, sometimes invest. And it's very hard to do that through a lot of private banks these days. And I think, you know, that's important. And secondly, given all of that, the charges are ludicrous. And it's a total, to me, it's a very serious question mark as to whether you're wasting your money.
Okay. Well, I think what would be fascinating if you understand a bit more about, you know, how you would have a different approach. So when you work with a client, or a small number of clients you've known for a while, what are the kind of elements that go into deciding that, you know, that bespoke piece that you talk about, and how you might allocate across different types of asset, what kind of risk profile they go for, and so on? What's the sort of process that you're going through there to make it more bespoke to that particular client?
Well, I mean, first of all, it's quite an intensive business in the sense that, yes, everything is bespoke. We don't have models per se, because we're not pilot high and sell it. You know, we're very bespoke. It's only a handful, literally a handful of families and individuals, but it's big enough to generate a business. And the name of the firm, you know, often people set up these wealth management firms and they have all these posh names based on streets in Mayfair or families. We haven't got any of that. It's just called plain money, Plain. And it's called plain money because the overriding principle or principles are that everything is completely transparent. I will show how anything being sold by any bank or anyone is broken down in terms of fees, as well as the fees I charge. It's completely open. And many private banks, despite regulatory changes, still often hide charges or don't spell charges out. And even though they have to disclose them on an annual basis, it still comes as a shock. But there are further hidden charges, I believe, as well in some cases. And so I try to make the whole process transparent so clients know where they are. And secondly, another overriding principle, I think, is that, you know, everyone will say to you, as an investor, you want to outperform a benchmark, you know, I'm sure people do, or they want a certain absolute return on an annual basis. And that means picking superior stocks and those that will outperform a benchmark, for example. And, you know, my view here, not an uncommon view among certain people, is that, of course, it's extremely difficult to choose top winning stocks. It might seem easy in a market like today, where technology goes up on an almost daily basis, but routinely it's very difficult to do it. And it's certainly extremely difficult to do it on a consistent year in, year out basis. And there will be times when people fail. The reality is that the fund management industry, which hangs its head in shame at its performance when you look at tables from rating agencies such as S&P, etc., that show most funds in the UK, for example, have just simply do not outperform the benchmark that they're aiming to outperform. 100% failure rate, across these tables, and so you're paying money to someone who can't outperform a benchmark, a firm, and you're paying for that, and so you're underperforming the benchmark even more. My view is that, given that it's so difficult to pick winning stocks year in, year out, you will get a more consistent boost to your long-term compounded returns if you focus more, of course, on cutting costs. You can cut costs straight away, and it's something you can do on a consistent, sustained basis. And I think that if clients work on that, and I'm someone who is capable of helping clients do that because I know the cost structures, then they're going to put themselves ahead. If a client, let me give you an example. Let me tell you how it really works. If you are a bog standard discretionary client of many banks, many wealth managers, all they do, they don't even do very much. They work out an asset allocation for what it's worth. And that's to say how much they're going to stick in USA, how much in Europe, how much in the Far East, how much in equities and bonds. And they work this out. And then what they do is they express that view by buying a whole range of funds managed by other companies. And those funds are actually investing in individual stocks. So your company is not actually choosing stocks, it's just choosing a range of funds. For choosing that range of funds for you, they charge you anything from, say, 1.5% a year, maybe even more. So you're charged that just for them to buy you some funds and make an asset allocation. Expensive. Now, when you've bought those funds, of course, all of those funds have inbuilt charges as well, which could be 1%, 1.5%, maybe 0.75%. I don't know, but let's say around 1%. So if your wealth manager is charging you 1.5% to buy you third-party funds who actually do the work, and you are then being charged for further 1%, for example, by the underlying funds, plus some associated charges, clients are potentially paying, in that case, and this is common, 2.5%, maybe to 3% a year in fees, even though they think they're paying often 1%, 1.5%. Now, on a long-term basis, equities, global equities, have delivered an annualized return of about 6 to 8%. So let's take 7 as the median. Over the last year, it's been a bit higher, US equities, maybe 8 to 10%. But long-term, let's take 7%. You've got a return of 7% a year. That's good for you. Now knock off that 2.5 to 3% to the fund management industry. And then let's knock off another, say, 2.5% for inflation, although that may go higher. So we're talking about 5% plus out of the 7% gone. You're left with 2% is your real return, rather than the returns you're getting on an annualized long-term basis. So your money is being put to work and you are getting the smallest slice of the cake, and you're basically funding through effectively an annuity for not much the whole of the fund management industry, which has grown rich on your back. Now, if you take a different approach, cut out these people, who Warren Buffett would call helpers, handy helpers, always there to help you when there's some money to be taken. And you can basically buy very cheap trackers. Everyone knows this story. Your clients, your followers are sophisticated enough, and no rocket science. You buy trackers, which are exchange-traded funds that simply buy effectively all of the investments in an index and aim to perform more or less broadly exactly the same as the index, minus a marginal fee of about, say, 0.1%, 0.2%. So de minimis fee. Hardly worth noticing, relative to proper fund management. Now, this makes sense to me because if you are buying a fund through a wealth manager, he's taking his 1%, 1.5%, they're taking their 1%. And I've already said that, on the tables, virtually all fund managers fail to beat their benchmark. So if they're failing to beat their benchmark, it's largely because they probably closet the benchmark or are very close and track it secretly, or whatever. But the fees make it impossible for them to beat the benchmark. They can't generate consistently enough excess return to keep outperforming that benchmark, so fees will always hold them back. So from the get-go, which they don't say to you, you are onto a loser. They won't outperform the benchmark over the long term. Therefore, it's logical, surely, simply to buy a tracker which at least can match the benchmark. Now, you may say, well, we have a fund manager who's outperformed massively the last year or two. You do get this. They do have good years and some have very bad years. But I'm talking over the long term. And what everything I do is structured around is long-term wealth generation for clients. Now, these, if you just bought a tracker for the S&P 500, rather than paying 1.5% to a wealth manager and 1% to a fund, you know, you're already the best part of 2.5% a year better off. Now, if we're talking, say, 2.5% on a £1 million, £2 million portfolio over 20 years, we're talking hundreds of thousands of pounds. So, you know, this is how we're trying to work. So what we do is we buy a lot of trackers. We do a lot of things, and I won't go into all of the detail, but certainly a lot of trackers to slash costs, get a return. And then what we do is we buy direct equities on the side to a limited amount, simply to generate high quality, high conviction ideas, to generate excess alpha, excess return, which helps us generate a little bit more than the long-term benchmark, which we're happy with.
Okay, so, well, I think it's you know, that's obviously a core part of the approach. Let's talk about and essentially that's focused on the stock market. So if you're working with a wealthy client with a significant portfolio, what proportion of their overall wealth would you put into the stock market, and what would you do with the rest?
Well, it's a tricky one, Graham, because it's there's no set rule. Because, you know, my clients are of slightly different ages and different stages in their careers. And pretty much all of them, most of them, are still very active in business of their own, businesses that they've created and are employing people and working very well and are growing. And so obviously a lot of their resources are devoted to these businesses, or are you know, providing growth funds or working capital to those businesses. But obviously, I encourage them to save, and excess capital gets paid out or invested within the business. And so really, you know, they're all around a similar age to me. So they're sort of late 40s, 50s, and they're still active. But I encourage them for excess cash to invest it in the stock market, or at least invest it externally to their business for diversification and for growth. And they do that. So I can't give you a definite answer, because I can't say to someone, take all of that money out of the business. It depends. But the excess cash they have, and we're talking about millions and millions, or money they can pay out on an annual basis as a bonus or whatever, because they own these businesses, often 100%, even though they employ large amounts of staff. And we invest some of that in trackers, as I say, public equities. We invest in some property to a limited degree, functional property, i.e. property people live in, and bonds and some derivatives. And we from time to time we invest internationally, and we do use leverage from time to time. So we will borrow from banks against portfolios to boost returns. And of course, we have reduced that recently quite substantially. Because the market has been high. We reduced it in the fourth quarter of last year, actually, which was quite lucky. But obviously, over the last 10 years, since the financial crisis, where we started these sorts of plans, we have in fact been able to borrow at say 2% against a large portfolio, 60% of the assets. And we have been able to get significant returns over the last number of years, certainly from US technology, where we're heavily overweight. And that is basically more than double that annual return rate. You know, so basically you can see it two ways, either a double return, or your trajectory towards your retirement age has just halved and gotten faster. So we've made substantial returns from using borrowings as well. So we'll use any asset class and any means we can to generate returns. But obviously within a very cautious, risk-controlled framework as well, because we don't trade, we're not in and out, This year we've done a bit of that. For example, we bought a significant position in the William Hill bookmaker business when it was almost 30p in March after the lockdown. Absurd price given the inherent value in the business with its US gaming licenses, and we sold that for a month later for about £1.20. So we were able to quadruple our money, and we also took a big turn of about 30% in Czech, the very, very attractive US education business. So we trade when there are sharp movements in prices, but we don't look to trade. For example, one of our biggest holdings, as I see here, across the portfolio has always been either Microsoft or PayPal over the last 5 years. And they've delivered splendid, multi-100% returns. And in the core portfolio now, Microsoft and PayPal represent about nearly 20% of the assets. So it's gotten very big. But this portfolio at the moment is totally geared into the market we're in. And the core portfolio with us now, with just trackers and direct stocks, mostly 70% trackers, 30% stocks, but big high conviction ideas, we're up over 13% this year. The UK is well down. The S&P 500 is flat, and we're up 13.5%. So this year delivered great returns for people.
As we now kind of go forward, we see massive interaction for the market by the Federal Reserve, Infinity Fed, buying up not just government bonds, but now corporate bonds, ETFs, can't be long before they go into direct equities. How do you feel about participating in a market that's having all this sort of new excess liquidity thrown at it? Is it a case of you've got to kind of ride that gravy train, or is there a fear that when the punch bowl gets taken away, there's going to be an almighty crash?
Well, I presume there's, I say presume, it's there's going to be a denouement to the current state of play. I mean, my conviction for being invested this year has always rested on the Fed's intervention, coupled with the fact that we have a US presidential election in November. Now, Donald Trump is like a man in a pit. He is got two outcomes at the end of this year, if you want to put it bluntly. One, he's going to be president again, or two, he's going to jail when the court cases start, probably. So that man is going to fight to the death. And I believe, and we're not there yet, so I really believe that the central plank of saving Trump and keeping America happy relies on stoking the market. So I've got no doubt that this will continue successfully. I do believe that, and I'm going to ride the gravy train. I'm not one of these people that dismisses it all and is sitting on the sidelines, skint down this year. Tragic situation to be in, and so we'll ride with it. But where will it end? Well, we can have a conversation about this all day, and I don't want to go on and on and on. Will it end? How will it end? Will it ever end? Will people just forget about it, and will money just be thrown in forever and buy these stocks and try to keep a lid on inflation somehow? I don't know. But the money is pouring in. The confidence is there. It's defied all of the skeptics. It's not itty-bitty money on a small volume scale. People are buying into it. Now, I accept some of the stocks we have, PayPal's, not so much Microsoft, but say PayPal, some of them, they are valued, Adobe is a very good example. Adobe, very, very highly valued, so they've got to get it right. But so far they're delivering. I'm quite comfortable with our positioning. More and more, I'm not particularly attracted by some of the UK. I don't have much investment in the UK, luckily. But I am sort of drawn a bit more to increasingly to buying euros and euro stocks, and we'll be looking at that. But for the moment, I'm just charging on. I'm full of video games. I'm full of Adobe, Nike, Micron technology, and buying chips for 5G and the cycle term, and defence. And we were also lucky with our defensive stocks as well, like Reckitt Benckiser, the maker of Dettol, which we bought last year as a high-yielding recovery stock. That's up 25% this year, and so we've had a great run. And I'm just going to sit tight, close my ears, and watch how things go. But my vulnerability, of course, is that there could be what they call a rotation. We had one last year that faded out quickly, but at some point, some kind of rotation out of technology and into more cyclical, undervalued stocks. But while interest rates and yields on the yield curve remain so low, and economic data is not really particularly encouraging, I think the environment is still favouring high growth companies, and that's where you need to be.
Okay, and I was going to say, you've talked about obviously the trackers to get diversification, but then the direct equities based on, I think you used the term high conviction. What are the kind of areas where, I mean, technology clearly is one of those winners. As we go forward, we're coming out the other side of COVID-19. Are there any new kind of areas where you think that kind of conviction could take you into some new stocks?
Well, it's very difficult to say. You know, my conviction is not universally applied to technology, and so it could rest anywhere. But I think, just looking at my list, I'm not pure technology. I've bought some cash flow stocks in preparation where I see good upside. Philip Morris, the cigarette maker, which may not appeal to everyone. I have an interest in Carnival, the cruise business, which is a company that could enjoy, it's speculative at this stage because time is difficult. But I think the travel sector will come back. It's not the end of cruising. I mean, if it came back after the Titanic and the sinking of the Lusitania, I'm sure we'll be cruising again. But it's getting the numbers right, and I have, for example, the confidence in that industry that they're past masters in discounting to fill every cabin and get the profits when the people are on board. And I think that will come back once they sail. So that's dirt cheap. You're buying that for peanuts at the moment. So we look at areas like this. We've had to look at some of the airlines, but we haven't really started yet. But we are looking to stay with some technology and some other areas as well, where we have high conviction or where we see strong brands. We have some interest in pharmaceuticals as well, and we'll see how that goes. And of course, at some point, I need to take a view on where the US election will go, because it could well have a big impact on the market if Biden does win, possibly around some of the healthcare stocks, positive or negative, because of action over insurance and capping pharmaceutical costs. And I think there could be trouble ahead, clearly, for some of the social media businesses. So it's a year of confluence, and I'm not rushing to do much. And I do strongly believe that inertia can be a bit of a winning strategy. But for now, I'm quite confidently sitting tight. But there are some great stocks out there, relatively cheap even now, and I don't think people should be shy. And I think people who have dipped out of the market or ignored it this year, it's been a great shame. I mean the Nasdaq 100, so that is big tech from its low point. Now, I'm not saying people who catch the market at the low, but close to it, is up over 50% this year, and we've never seen anything like it. This is extraordinary. And
so we talked a lot about wealth creation, but I think one of the other things that's massively important to the kind of clients you're working with, of course, is wealth protection. And one wonders what kind of new taxes might be coming our way to pay for all the government largesse of recent months. What are the kind of conversations you're having with these families about either structures or residencies or citizenships or anything that's kind of designed around how to hang on to the wealth we've already got from the kind of pressures we might be under in the next few years?
Yeah, I mean, I think it's an important consideration. I think a number of my clients are not actually UK domiciled, but we do have these conversations. It's doubtful, all of them will be living in the UK when they do retire. But we try to invest money within their businesses sometimes, rather than paying it out to them as dividends. Even though tax will have to be paid eventually, they may not be in the UK when they receive those dividends later. So we invest like that. We sometimes invest in a client's individual name, but we borrow money and we cross-collateralize that loan against the business's assets. So in effect, the client is able to invest, but there's been no distribution from the business, and we do quite a bit of work around, have been doing, because it's not my expertise. I bring in experts for this sort of stuff, firms, but we've been doing quite a bit of work around inheritance tax and setting up special purpose vehicles for investing assets with structured share classes to allow voting rights to be retained until death, but non-voting shares to be given away before death to try and limit the effects of inheritance tax as well. So we've been doing a lot of that. But when it comes to in securing wealth, we're in a very difficult period, as of course we all know, like many of your contacts as well. And I've got clients whose businesses are stopped and on furlough. So the priority is to maintain their wealth and their cash flow, but also ensure that their businesses thrive. And I've been trying to work with clients on this as well in terms of timing and getting back to work. And it's extremely difficult. And no entrepreneur wants to be sitting paying central London office rents for empty offices and no prospects of future revenue for the time being. So that is the challenge. But it's a tough one. But clients are doing well, and clients or people generally who are in the stock market and have got positive returns. Investment trusts, some of them have got positive returns. COVID-19 has been a big wealth generator.
That is amazing, isn't it? I think as we come towards the end of our time together, Stephen, it feels to me like it's actually a very positive message you're giving, that despite all of the negativity and the fear from the media and the government, if we keep our heads down and look for the opportunities, there are some great returns to be made in the markets at a time like this.
I would agree with you, Graham, and I think as long as people take a long-term view, if you're 40, 50, whatever, you're going to work maybe for another 10 years. I don't know, but we're in the eye of the storm. This is always the case in the stock market. This is the best time to be looking to do things in ways, not sitting tight under a rock. When we look back in 10 years' time, presumably we're still not going to be on another wave of coronavirus in 10 years' time. So let's assume not. When we look back in 10 years' time, it's a total blip and the market will be higher. I always believe that the market will be higher because I believe in human enterprise and human needs, and that will always prevail. And so it's a question of, time will always be your savior. And if you maintain confidence, sit tight, look for opportunities, go and do something else and leave it, you will be happy in the years to come.
Fantastic. Well, that's great advice to end on this. Stephen Connolly, thanks very much for joining us.
Thank you very much. Lovely to talk to you.